Hello, I'm Thomas Taplin and you're watching Dukas Copy TV. A subject that's been frustrating markets over the last month or so is the ever-increasing presence of inflation. Now, in Europe, some analysts are calling for more rate cuts simply to curb the growth of inflation in certain countries. Well, joining me now is 20-year veteran markets analyst Michael Hewson of CMC Markets. Michael, welcome to the programme. A great example today regarding inflation is seeing the Dutch inflation rise to 3.1%. That happened this morning. Firstly, what's happening in the Eurozone at the moment with regards to inflation, and what do you believe is the most effective way forward for central banks now?
Well, I think, obviously those Dutch figures this morning, inflation coming in at 3.1%, and yet when you look at Germany's inflation rate, it's probably half that. So, I think that's really one of the problems that's, sort of vexing Mario Draghi and the European Central Bank in general. There is no one rate that can really effectively handle inflationary pressures within the Eurozone. But I think there's more to that than, just a simple measure, because I think when you're targeting inflation, you need to have a single mechanism to target it. And I think the reason why the Dutch figure is so high is because they've had to raise taxes. Now, if you're raising taxes, it's going to put upward pressure on inflation. And obviously Germany haven't done that. So you're going to have a completely different picture from one country to the next. And I think what this Dutch figure does is it highlights the inherent weaknesses in the euro area, the fact that the European Central Bank has to set inflation or set interest rates to target, a single inflation measure across 17 member countries. And that, what it does is it basically highlights the fault lines within the euro area in trying to manage monetary policy. And essentially, I think that's why the euro is probably the more resilient of all the G3 currencies when you compare it to the pound and the US dollar, because the UK and the US are able to have a much more accommodative monetary policy than the ECB can currently do within its mandate.
Now, you believe central banks should show more face and start making rate cuts across the board. Will this actually change anything in the medium to long term, though?
As far as the ECB is concerned, no, I don't think that it will, because I think it's not just about what the central bank can do. The central bank can buy time, can buy government's time, but if governments don't use that time effectively, then really all that's happening is you're delaying the inevitable. And, I think politicians really need to take ownership of the issues that need addressing within the euro area. Unfortunately, they're not able to do that because they're riven by political division. You've only got to look at what's happening in Spain, what's happening in Italy, and what's happening in Greece. Unfortunately, government reform programs are moving at best at a glacial pace. And unfortunately, that's not going to get Europe out of the economic funk that it's currently experiencing at the moment. Yeah, we are seeing some evidence of a recovery in some of the key indicators, but I fear that's just a dead cat bounce, largely as a result of the summer season and the brief boosts to hiring that usually gives with respect to tourism in Spain, Italy and Greece.
Some analysts and commentators are saying the Eurozone is slowly climbing out of the hole it fell into back in 2008. Are the markets showing any sign of accepting that, or are recent inflation figures, for example, overriding it all?
I suppose it really depends on who you talk to. I would like to see more evidence that the current rebound in economic activity can be sustained into the winter months before I start declaring victory with respect to the euro area. If you actually look at the growth figures within Europe, it's Germany that really is showing any signs whatsoever of any economic recovery in the second quarter. You could argue that Spain and Italy are showing signs of progress, but their PMI data is still very much in contraction territory. So they're just basically contracting at a much lower rate or a lower pace. What I would hope to see is these seasonal decreases in the unemployment rate sustained into the third and fourth quarters. Then I would probably be more confident about the fact that Europe is starting to dig itself out of the dirty, great big hole that it's put itself in over the past 2 to 3 years.
Just a quick zoom in on the euro, Michael, before we finished. It's going to start getting stronger now, isn't it?
I think if we can overcome 134.10, then there's a good possibility that it can. The only caveat I would add to that is if the Fed does look to start tapering asset purchases aggressively, we could see a US dollar rebound. I certainly do not think that the euro above 135 is anywhere near sustainable, and I think if it does go above those sorts of levels, it's going to give Mr. Draghi a massive problem. I think going forward after the September elections in Germany, we should get a better idea or a better steer of how much more flexibility Mrs. Merkel will allow Mario Draghi once and if she gets re-elected.
OK, thank you, Mr. Hewson, for joining me today. That's all from me now on Dukas Copy TV. Don't forget to check back tomorrow, where I'll be bringing you a roundup of some of the key events to have moved and shaken the markets this week. That's in the week ahead tomorrow. But for now, goodbye.